Patrick Camuso here from Camuso CPA. What I want to discuss today is historical accounting for cryptocurrency transactions and cost basis reconstruction. And this is for the investors and businesses out there that are behind on their accounting. And, when I'm speaking with many investors and businesses that maybe, are 5 to 10 years behind on doing their portfolio accounting, I often tell them that, this is very common. We do this every week at Camuso CPA. And the reason why is because the digital asset compliance rate, according to the IRS and to other sources, has been historically low. And most taxpayers for years have operated across multiple wallets, multiple exchanges, DeFi protocols, bridging, staking contracts. And, these were happening across various data sources that were non-standardized, with many questions around the tax characterization of these transactions. And, taxpayers basically just had to rely on automated crypto tax software outputs that they often didn't reconcile properly and do the proper due diligence on. And what this leads to is that the summaries and reporting that have been produced rarely reconcile at the tax lot level across platforms. In fact, when I'm on an initial consultation and someone is maybe discussing this with me, I'll ask them, do your calculated ending holdings verify back to your actual ending holdings across, on chain and across exchanges? And many times I find people have not even done this simple due diligence check to verify just a basic level accuracy of their cost basis. So, the result of all this is incomplete accounting, incomplete acquisition histories, unmatched transfers, incorrect holding periods, inventory pools for your cost basis that can't be carried forward with precision because they're not at the tax lot level. And, the problem with this is that your cost basis calculations are a cumulative process. So if you make an error in your calculation for your ending cost basis in year one, that becomes embedded in your calculation in year two as the starting point, and then it can carry forward in perpetuity until you finally dispose of these assets that you have the calculation issues embedded in. So these errors don't self-correct. They compound. And now with Form 1099 DA broker reporting being rolled out, these discrepancies are going to be detected at a much larger scale and much more systematically by the IRS and other tax agencies. And that's why cost basis reconstruction and historical accounting to get your portfolio fully accurate is now more important than ever. And, this issue of the historical accuracy of your basis is not going away. So what does cost basis reconstruction really mean? So if you take a step back, digital assets are treated as property for tax purposes. So what that means is anytime you acquire a digital asset, you need to calculate what the acquisition price is, and then that would be the cost basis for that asset. Anytime you sell an asset, you would calculate the proceeds for that sale, and then you would assign the correct tax lot for your cost basis to then calculate what the overall gain or loss is for that transaction. So all cost basis reconstruction is going back from your earliest transaction and systematically rebuilding your digital asset ledger at the tax lot level to make sure that we are calculating each acquisition appropriately and each disposition appropriately, including making sure that we're applying the right cost basis tracking methods and cost basis calculation ordering in order to make sure that these calculations stand up to scrutiny. So reconstruction is not just, plugging these wallets into the software and generating a tax report. We're establishing the continuity of your basis and tax lots across all platforms and all tax years. And, this requires obviously, proper methodologies, due diligence, and documentation. Now, one question I get a lot from taxpayers when I'm having this conversation is, can I just start fresh this year? Or, my activities in the prior years, maybe it doesn't matter as much. Like maybe like, let's just start this year, or let's start last year. But the issue with this is that in most cases, you can't do that. There are some isolated cases that you can, if maybe one year you sold out of everything like 5 years ago, and then you got a fresh start last year, maybe we could just start from then possibly. But in most cases, the answer is no, because your cost basis calculations are cumulative in nature. If you understate your basis in year one, year two begins with that distorted opening basis. Same with your holding periods. If they're misdated or misordered, your long-term and short-term classifications can become inaccurate. Similarly, if certain transfers were misclassified as taxable events, or if certain transactions had the wrong tax characterization applied to it, this is also going to impact the basis and will create a contaminated basis that's getting carried forward. So ultimately, you need integrity across your whole calculation to be sure that a cumulative basis for any one asset is accurate for the current year. So that is why in almost all cases, if you're holding legacy assets, you need to go back and reconstruct your cost basis and fully complete your historical accounting accurately with the correct methodology, so you don't have these discrepancies and cost basis issues following you around in future tax years. So when you're doing this cost basis reconstruction, it's only as strong as the documentation and audit trail that it produces. And, I'm not going to get into every single granular detail of this outside of the scope of this video, but you want to have a tax lot level cost basis report. And many softwares don't provide this. You want to have your gain or loss report, all of your dispositions that are being able to be tied back to the specific tax lots that you're applying to that. And the real important thing with this is that your methodologies have to be correct, right? Because if you're not applying the correct accounting methodology, both in terms of the selection between FIFO and spec ID, but also how it's applied at the wallet or at the universal or account level, you're going to have different cost basis assignments. And this is where the granular level details are deeply important, because this is going to dictate the integrity of your cost basis calculations. So you need that lot level schedule, you need the disposition schedule, transfer reconciliations. So every transfer should be reconciled appropriately, and you want an assumptions register where you're documenting all assumptions, all tax positions, any data gaps that you had, so you can support any of these assumptions or tax positions you took where something isn't clear, so you can support those future basis positions. And you want a memo that's detailing the methodology that you apply to your calculations, and summarizing some of the assumptions and issues that may be contained in the calculation, so that way you have a fully supportable position. So without these elements, you may have numbers, you may have an output from your favorite crypto tax software, but that is not going to hold up to scrutiny. You need the documentation around all of this information in order to substantiate these positions if you do come under scrutiny with the tax agency. And, this sort of brings me to the next important point, because everyone's out here, plugging their wallets, plugging their exchanges into the crypto tax softwares, and in many cases, blindly trusting them. And this does not lead to good outcomes. And what I first want to point out is that, crypto tax softwares are a computational tool, and they're a tool that is necessary to complete this process that we're discussing here. But these tools are only as good as the information that you're putting into them. And what's been found in my practice, and also via independent research that's well documented, is that different platforms produce different results. And this is for a wide variety of reasons. There's a lot of data issues associated with all of the data sources that are going to go into your calculation, because none of this is standardized between all the exchanges and all the blockchains and the APIs that they're using to bring this data in, it's not standardized, and there can be a lot of issues just at the data level. The tax characterization that various softwares apply when it comes to wrapping and unwrapping treatment, liquidity pool classifications, staking reward timing, fee capitalization, pricing sourcing methodology, NFT mint mechanics, transfer matching logic. How are you going to treat a transfer if there's a data gap, and these types of things. There's divergence across all of the crypto tax softwares on the treatments across all of these types of transactions. And, this leads to different platforms routinely producing material different results for identical transactions if you were to import them into multiple softwares. So you can't blindly rely on the softwares. You do need to utilize them just, for the reconciliation process, but you need to ensure that the methodologies that you're using, the assumptions that are being made, the steps for the reconciliation and due diligence are being overseen with proper due diligence by you or by a CPA, and also that it's being documented appropriately. So you can't just blindly rely on the softwares. You need to apply a strict accounting and tax process that leverages these tools. So, one area that's going to start to bring a lot of these cost basis issues center stage for taxpayers is Form 1099-DA is largely changing the landscape for crypto taxes. So beginning in 2025, brokers are going to be reporting mainly proceeds on Form 1099-DA. In future years, cost basis reporting is going to be phased in, particularly on covered assets. And, I have separate videos on Form 1099-DA. I'll link to some of those in the description, and I encourage you to watch those because there's many details outside of the scope of this video. But the bottom line with Form 1099-DA is that this is third-party reporting that the IRS is going to reconcile against your self-reported positions on your tax return. And this is going to force a reconciliation between all of your historical acquisitions, particularly when you do dispose of those historical acquisitions and all of your activity that's taking place. And to the degree that your historical activity is not calculated correctly, you're going to have issues when you have to reconcile and report your cost basis for those dispositions on your tax return and reconcile them to Form 1099-DA. So, Form 1099-DA is going to allow these transactions to be much more systematically identified where there are discrepancies, and it's also going to allow much greater scale in the IRS flagging these discrepancies. So overall, as we start to see this third-party reporting regime roll out, the tolerance for unexplained discrepancies is going to continue to narrow. And in order to survive the automated reconciliation and third-party reporting, it's imperative that you get these historical calculations and cost basis done and completed correctly. So there's many mistakes that you want to avoid. You cannot treat your software outputs as your full tax documentation or a fully accurate calculation without due diligence. You need to make sure that you're reconciling all of your transfers and that you're applying the correct tax characterization to all of your transactions. You need to make sure you're in compliance with Revenue Procedure 2024-28, which changed the accounting methodology for digital assets in how different accounting methods are applied and how the tracking is done between wallets. And so again, outside of the scope of this video, there's other videos you can watch me go into detail on that. And you also want to watch out for undocumented assumptions and for not retaining your lot level cost basis file, but really all of your reporting after you do a calculation in the crypto tax softwares, because that's another issue I see. But you also want to make sure that you do get that tax lot level cost basis report to be able to roll that forward. So, there's many pitfalls to this that you want to avoid to make sure you have a calculation that has integrity. So we're entering what I call the digital asset compliance era. the environment shifting from voluntary self-reporting to third-party automated detection. And, we're seeing this first with Form 1099 DA. So it's imperative that as we're entering this new phase, that you have audit defensible ledgers that allow you to substantiate your cost basis with documented positions and methodology related to every step that went into the calculation with full audit trails to support this. So that's what we're assisting with at Camuso CPA. If you have fragmented wallet history, unresolved transfers, DeFi activity you haven't been able to characterize appropriately or deal with the on-chain data issues related to it, if you have any legacy accounting issue related to your crypto portfolio, this is something that we can assist with at Camuso CPA. Every week, we're going back 5, 10 plus years for clients. We're working on clients now going back as far as 2014. We got another client we just onboarded from 2017. So, we're able to go back, deal with all the issues from this whole historical period and get your portfolio calculated in a manner that will be defensible. So if that's something that you need assistance with, you can reach me for a consultation at CamusoCPA.com. Visit the contact us page and fill out the form submission, and I'd be happy to speak with you further. Until next time, I'm Patrick Camuso signing off.